Okay. Good evening, everyone. Uh,
Good evening, sir.
Good evening, Saurav Agrawal, then others. Good evening. Then we have Aditya. Good evening. Then we have who all are there? Okay, what we will do is we will start the session, assuming that you guys have already reviewed um, the document, the pre-read material. Others, if you get a time, please send the pre-read material once again for people who could not read it.
Yes, sir.
Yes, just send it once again. Um, Please make sure you read it, otherwise this chapter will go above your head. Anyway, we'll try to cover. So we'll start right away rather than waiting for others to join in. And as I have told you guys, the core idea here for arbitrage principle, which we started last time, is nothing but it's the same thing actually, which cannot have two prices at the same time. So arbitrage happens when thing is same, say mobile phone, iPhone, right? Uh, Arbitrage will happen when this iPhone in India, which cost 1 lakh rupees, and same iPhone in Dubai, it costs 75,000 rupees. Do you think many people will go to Dubai and buy and come back? What do you think, guys? What do you think? If price of the same thing is different in two different market, what will happen? What's your thought process?
The people will purchase that product from a market where it is getting cheaper.
Cheaper. They will go to Dubai, buy it, bring it here, maybe sell it. What is the arbitrage value here? How much is arbitrage value?
So the difference amount.
Difference amount. So 1 lakh rupees, 75,000. So 25,000 is the arbitrage difference. Even though people pay, said 10,000 or 15,000 for the flight, the arbitrage value remains 10,000 additional. And hence many people actually does this work. They go to Dubai, buy their laptop, mobiles and come back and they cover their going and coming fees plus enjoyment and plus they save money. That happens because the core idea of arbitrage. So if gold cost you $1,900 in New York, and $1,950 in London, do you say there is arbitrage? Do you see there is arbitrage? If 1900 in New York, $1,950 in London, do you see there is arbitrage?
No,
Absolutely.
sir.
Absolutely. Here you can buy from London, sell it in, sorry, buy from New York, 1900, and sell it in London, make $50 risk free. There is no risk. Both are gold only. Okay. So there is no risk apart from the moment you bring it here and sell, maybe there is a trouble. And that is why arbitrage market doesn't work on delivery. Remember, what is the fundamental in arbitrage market? That you don't wait for delivery. You buy and sell at the same time. So there is no variation because of the time even. Is it not ideal world? Absolutely. And this happens. How many of you think it is rare to happen? And how many of you think it happens often? Tell me that quickly. How many of you think it is rare? It might not happen every day. And how many of you think it happens every day? It is not rare. It happens often. And people who thinks it's rare, they are rare. Actually, it happens often. Yes, it happens often. You will find NSC, BSC, there is a price difference. At same point in time, same stock, same news, prices will be different. And that's the arbitrage player works on. So in foreign exchange market, same logic applies to currency pairs. Example, you have these quotes noted down in your notebook. USD versus European Union, you have 1.1640 slash 1.1660. What is the example here? USD versus Euro, the rate is 1.1640 slash 1.1660. First of all, tell me which is the bid rate and which is the ask rate here. What is the bid rate? What is the ask rate? And also tell me which currency is base currency here. Which currency is base currency here? USD versus Euro. USD versus Euro. Okay, I can see many of you started typing in. Yes, USD versus Euro. That's the nomenclature. And there are two quotes have been given. 1.1640. Okay. And the second one is 1.1660. Tell me which one is bid risk and which bid rate and which one is ask rate, which one is price, which one is base currency. Quick. Everyone has to type in. Yes, everyone. Go ahead. USD is base currency. USD is base currency. Okay. How? How USD is base currency here? Now, what happens is, let me tell you guys, this is the one currency pair. Okay. These are the two different bid and ask rate. Tell me which one is bid and which one is ask. Put that bid into in the chat box. Bid is buy low, sell high, right? Buy low, sell high. Somesh, absolutely correct. What you will buy, which is cheaper. What you will sell, which is higher. So 1.1640, which is lower, will be always your bid. What will be sell in ask? S is in the between, right? It is 1.160. That's the difference. Now, when you want to create arbitrage, what people do is they take two currency pair. They do not play on one currency pair. They play with two currency pair in the same market. So the first one is this currency pair, and second one will be, for example, JPY versus USD. Second currency which was available in your market was JPY versus USD. That's the second currency. Clear? Now here, I'm again giving you two rates. Tell me which one is bid, which one is ask. Which one is bid, which one is ask. So JPY to USD is 110.20. 110.20, and there is one more quote which is 110.40. 110.40. Tell me which one is bid, which one is buy, which one is ask. Write both of them in the chat box. And this is the second pair. This is the first pair. This is the second pair. Which one is bid, which one is ask? What is the fundamental? Bid will be always low, ask will be always high. Why? Because you will always buy low, sell high. Buy low, sell high. And hence, absolutely correct, Vedangi, Vaishnavi, Ankit, Mahak, Somesh, Vinit, Mamtaj. Very good job, Sasank. Yes, that's the rate. Good job. Yes, make sense? Now you understand two different currency pair. Here, I want to create arbitrage. You know how I will create it? By cancelling out USD and USD here. If you cancel out USD here, get me a new bid rate and new ask rate for JPY versus Euro rates. JPY versus Euro rates. Quick, quick. This is the first time you are doing this calculation. Do it. Euro rate. By cancelling out USD, you can create a currency pair where you can make some arbitrage. Tell me this currency pair value first. What will be bid rate for this currency pair, and what will be the ask rate for this currency pair? And excuse my handwriting on the screen, okay? Clear? Everyone clear? What I want, have you understood? I need JPY versus Euro rate. So you are today's trader and you want to create a new currency, which is JPY versus Euro currency. Give me the bid and ask rate. And ask rate. And it's nothing but multiplication. Do a proper multiplication. Get me this number, everyone. Use formulas, use laptop, use mobile, whatever way. Yes. Anyway, next time we will have a daytime class. So you will do this live in the class itself. Okay. There will be test after this on foreign exchange and money market. You will find several questions on it. Others, we have to get that Google form ready. Okay. At least 100 questions so they practice enough. Now, go ahead, do simple calculation. What is the calculation, guys? Let me show you first one. And then next time when you get into the exam, you do it. Everyone has noted the number, right? Okay. Because now I'm going to clean this and we will do this calculation quickly together. So everyone, first let's start with bid rate. Let's start with bid rate. I want to create a bid rate of JPY versus European Union. Euros. Now, how I will calculate it? I have USD versus Euro rate. What is USD versus Euro rate? 1.1640, right? That's the number I have. 1.1640. And also I have a rate for JPY versus USD. Tell me the JPY versus USD rate. So I have USD versus Euro. Okay. And if I multiply this simply with JPY divided by USD, will I not get JPY and Euro remaining? Because USD will cancel out USD, correct? Are you following it? Put yes in chat box. What I will get JPY versus US Euro. So what I have done, I have multiplied two different bid rate. What is the second bid rate? Put yes in chat box and now you do this calculation. What was the bid rate for JPY and USD? 110.20. Do this multiplication, get me a number. Get me that number. Similarly, for ask rate, I will do the same thing. I will take USD divide by Euro, multiply that with JPYY. Everyone, go ahead and post the answer for bid first by dollar. And this time I will do it for what? Ask. This time I will do it for ask. So for ask, what are the rates we have? 1.1660, correct? 1.1660 multiplied by what? 110.40. So here I will get ask rate in form of JPY and Euro. Why? Because USD will again get cancelled. Tell me this number, tell me this number. Both numbers, everyone. Bid and ask rate. Very good. Bid buy low, which is 128. Buy low is 128 point. Anyone unmute and tell me what is decimal number here? And second number,
128.2
726, right?
726. Yes.
726. Clear? That's how you do different rate conversions. Now, once that is done, if a dealer is quoting JPY 129, okay, what will you do here? You will sell JPY, buy euro. Why? Because you have a combination which is cheaper than what you are getting in the market. If somebody is selling at 129, guys, what will you do? You will immediately start selling to him. Yes. Why? Because he's giving higher than what you are buying for. What you are buying for 1.28, 23 even. Yeah, for 27, right? 27 is your bid and ask. Clear? So you have a arbitrage if somebody sells at 129. Are you getting the point? So what you will do is you will start checking in the market. You will buy in this market, which is 128.27, and instead of selling at this price, you sell at 129, which is higher. And here in pips you make money, right? You pips you make money, percentage in point. That's what you make money. And that is why upside is humongous. Upside is humongous. Is it clear? Arbitrage is clear. Put yes in chat box, everyone. Now, everyone. Simple, right? It's very simple. Others already said yes. Everyone, go ahead, put yes. Quick. Then we will go and learn some other stuff as well. It's very simple. Check your new combination of rate and then go and check in the market if you have some leverage there. If you have, then you will start selling them. So first, what you have to do? First, you have to do the triangulation, and then you have to do the bid offer in the cross rate. Clear? Put yes if you have understood this concept. Simple, right? Simple concept. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 people. Okay. What about others? You are not following it? Anybody has been confused here? We have 24 people. Is it confusing? If yes, if it is confusing, say I'm confused. Okay, don't say yes for that also. Otherwise, I will be lost. If you could not understand this part, tell me. And if you could not understand, the reason is only one, that you have yet not read that pre-read material. Please read the pre-read materials. Others, can you send that pre-read material in the chat box once more in WhatsApp group, just for people to go and read it? Yes.
Okay, sir.
Okay, great. Now, if that is clear, let's go ahead and understand different types of forex trade. There are different types of forex trade. Now, imagine your government says our currency will always worth exactly 3.75 US dollar. If your government said my currency, and there are many government which has said like this and they follow. Let me give you example of those. Dubai market, Saudi Arabia, Oman. There are certain countries with this. They said my currency will always worth exact same amount in terms of US dollar. So if anybody wants to convert US dollar to my currency or my currency need to be changed to US dollar, I will always give or facilitate through our central bank at certain price. That certain price, for example, if a country decided 3.75 US dollar, so one currency of their country will be converted into 3.75 dollar. No matter what, that's a fixed exchange rate. And that's what the type of forex trade is. The first type is fixed exchange rate forex. Now, your currency is pegged to dollar like a boat tied to dock. Yeah, you must have seen, even though there are too much of currents, still that boat will be not moving anywhere. Why? Because it's tied to the dock. It can bob a little, but it won't drift away. Right? Now, how does government maintain this? The challenge is maintaining it, right? Saying that I want to fix $2, it's very easy. But can you maintain it? The central bank stands ready here to sell its own currency in open market if the currency is weakening. Okay. So falling below a peg, central bank, what they will do? They will start buying and keep prices up, matching to 3.75, which the foreign reserves props it up. So they have to, central bank has to have dollars. Then only they can buy that currency to maintain the prices. That's why you must have heard that if country has a foreign exchange in excess of, certain $1 billion or $1 trillion, your economy is more resilient. Your currency will not depreciate. Why? Because the moment it will start drifting away from the anchor, what will you do? You will buy. You will strengthen that rope, and hence it will not move out of it. That's how it works in market. That's why you must have seen that series which I recommended. How many of you got time and saw that series? What was the name of series, by the way? Governor, right? Governor on Amazon. I think they have launched it. Governor. If you watch that, they have talked about the same thing, that foreign currency with central bank dips to the level where monkey was falling, right? That's what the comedy of that series is. So if you remember that part, you will understand India didn't had enough foreign currency to maintain its pegging or controlling the foreign exchange, foreign currency transmission. Now, currently, similar situation. Just 2 years ago, India Indian rupees was 75 rupees. If you have 75 rupees, you will get $1. What is the price today? You have to get 95 rupees to get $1. Are you getting my point? So dollar became costlier, rupees become cheaper. Why that happened? Because Indian government forex is not enough to control, and Indian government doesn't want a peg currency. They don't want a fixed exchange rate. So the first time you have understood fixed exchange rate. What is the challenge with that? That central bank should have enough foreign currency to buy if the market weakens. Clear? And sells when they have stronger rupees happening, if their own currency is getting stronger. So why would a countries will choose this? What's your opinion? What do you think? Why any country will choose this regime? How does this help? Okay, write it down. Three reasons why they do it. First, certainty. Importers and exporter will know exactly what they are getting into. So if today I orders iPhone from United States, when it reaches my custom border, I know I have to pay exactly this amount. If it is $100, say iPhone I'm getting, 3.75 is the conversion. How much I will be paying? Exactly 3,750, right? Or 300, 750. Now that's what the real challenge is. Give me 1 second. Clear? So first part was certainty. So the importer and exporter know exactly what they are getting into. For example, iPhone you are buying at $100. When it will hit your country, it will be $375. 375 your currency, maybe Saudi Arabian Riyal. Right? Second advantage is low inflation. So inflation you can control. Why? Because whatever you are importing, you can control that price because fixed rate forces physical discipline eventually. So you can't print too much money, because if you will print too much money, it impacts the economics, and economics you have learned now. So you know exactly how that result into inflation. And the third part is credibility. Investor trust a stable currency, so borrowing costs are lower. Yes, they prefer a stable scenario, right? Investor always avoid uncertainty because uncertainty means cost. And hence, if you don't have uncertainty, you have a fixed rate, they will always prefer your money. Now, Hong Kong is another good example here. Hong Kong dollar has been pegged to USD for long. One is, means $1, one United States dollar equal to 7.80 since 1983. Since 1983. Saudi Arabia, I have already told you, 3.75 exactly. 3.75 Saudi Riyal is equal to 1 US dollar. It's fixed. Until 1991, even India, the case of governor, if you will watch, you will see India had largely fixed exchange rate. And after balance of payment crisis, India moved to manage a float rate or floating rate. And that's the second type we are coming to. Now, downside is if country faces a severe shock, say a financial crisis, yes, say a financial crisis when they deserve to peg, what do you think will happen? Just give me one sec. Yes, please. Yes. So if you can understand this, the downside here is country faces severe shock, say a financial crisis, defending the peg, which will drain all of your foreign reserve when reserves run out, and hence peg collapses. And that is why that is the major problem with fixed exchange rate. Yes, when country will face a problem, economic problem, and you must have learned that in economics. Economics, you had a subject, right, guys? You had a subject called economics, correct? In semester one or in semesters two, you have it.
in first semester.
Yeah, first semester. Awesome. So you know all this, right? Asian financial crisis. Now, this is the homework. Everyone, of course, your internship is finishing. Yeah, most of the people internship is finishing. Dr. Saurav, you did that research, right? When their
Yes, sir.
internship is finishing.
Some are taking more, sir. 15 days they will be having more
How many?
days
How
to
many people
complete.
research? Yeah, tell me how many people. 50%
Uh,
people, 200 people, 200% people, everyone.
50 more than 50%.
More than 50% people out of 24 will continue. So
But
what we will do, we will do this homework only for people who have not taken the extension. Can you send me that list? Yes. So next week when we will have the session, we'll make sure that those people does this presentation. Okay. Presentation on Asian financial crisis 1997. Who all wants to do? Who are stopping their, they might take extension, but still can spare time. Put their name right now or say me in the chat box. If you can take this as a presentation assignment, we'll have this presentation happening next week. Go ahead. Go ahead. Go ahead. Okay, Somel is doing that. Yes, hello. Mamtaj is doing the. So I can see Adarsh, Vedangi, Disha, uh, Mamtaj, Somil, four people. Okay, so four people will do this Asian financial crisis together. Yeah, prepare at least 15 to 20 page slides, half an hour time, 15-minute time, actually, not half an hour, 15-minute, okay? 15-minute time, everybody will do 3 to 4 page presentation on Asian financial crisis. What exactly has happened? How the foreign exchange, a fixed foreign exchange, created this scenario, I want to know. Clear? Aditya, Aditya is also saying he will be free by 31st, so he will do. So Aditya, you can join the group. So Aditya, Adarsh, Vedangi, Disha, and Mumtaj, and Somil as well. Okay, six people. Great. So go ahead, make the Sasank also. Sasank, where is Sasank? Acha, he can't speak. He doesn't have. Acha, he's not in the class. Okay. Okay, okay. He's calling you. Okay. So he's joining online with call. Okay. Clear. Okay, great. So you guys have understood the homework. 1997 Asian financial crisis, exactly what has happened because of the fixed exchange rate. That's what you will be presenting, at least 15 slides, 15 minutes. That's it. Yeah. Now, let's understand the second rate, which in 1991 India has undertaken. India has undertaken. Imagine the opposite here. Your government says here, we are not going to fix anything. Let the market decide what could be my value. That is called floating exchange rate. The exchange rate is determined here purely by supply and demand. The supply of that currency and the demand of that currency every micro millisecond, every trading day, it gets decided in the market. So if more people wants to buy Indian rupees, what will happen? If there are less people to sell and more people to buy, what will happen? Rupee will appreciate or rupee will go up. Rupee will be pricier. Clear? And if more people want to sell rupee and run away from India, what will they do? Rupee will go down because supply will be more, buyer will be less. Simple. Now, most major world currency float. Remember this. Most major currencies today float. That's why they get the respect. So to have respect, what is required? That you should be having a floating currency, US dollar, European Union, euros, British pound, Japanese yen, Australian dollar, and Indian rupees. Everything is float now, free float. These are called freely floating currency. China, tell me, China is a free float? Chinese currency. What do you think? Is it a free float? How many of you think it is a free float? If you say it is a free float, then you don't know China. China will say everything but does nothing. Because when Chinese product goes, it goes to the Chand. And if it is, बोलते हैं ना कि चाइनीज प्रोडक्ट चलेगा तो चांद तक चला जाएगा और नहीं जाएगा तो शाम तक भी नहीं जाएगा. Have you heard that? Yes. They want to feel that everything is free float, but actually मेरे साइड से हो गया हो रहा. Okay, now, so you guys got it right? Am I audible now? Am I audible?
Yes, sir.
Okay. So what I was telling you is that China wants world to feel it's a free float, but they are not free float. Obviously, right? Because that is how they work. Yes, that is how they work. So floating currency mechanism, you have understood exactly opposite of fixed currency mechanism. where most of the currencies are today floating currency: Australian dollar, Japanese yen, British pound, US dollar, euro, and even Indian INR. These are called free floats. Now, here is a nuance: almost no currency is completely free float. Remember that as well. So it's not only Chinese, which is definitely not free float. Even most of the currencies are not free float. Why? Because whenever country will see there is too much of volatility, extreme volatility is happening, they will intervene. They will definitely intervene. India to does it regularly. India does it regularly. 589403. India does it 589403. India does it regularly. So that's the nuances. This is called managed float. Always remember that is called managed float. That is called managed float or dirty float. So in your notebook, everyone, what is the nuance? That no currency is completely free. Most central bank do intervene occasionally to smooth the extreme volatility, and that is called managed float or dirty float. India rupee is managed float. The RBI steps in when it gets too volatile. Always remember, RBI will step in. Why floating is better than most developed countries? Economics. Why floating better for most developing countries? Why it is? Tell me why it is good for India. Because it acts like a automatic stabilizer. If a country runs a trade deficit, its currency weakens, makes export cheaper, automatically fixing the problem without government action. That's the advantage because of automatic stabilizer. Second, monetary policy freedom. Monetary policies cannot be linked with physical policy. Hence, you have learned all that, so I'm not going deeper on economic side. But economics is very important in finance. Always remember, central bank can cut or raise interest rate for domestic reasons without worrying about depleting currency reserves to defend the peg, because you don't need to use any reserve. Reserve is required in case of which? Fixed currency. It also acts like a shock observer, remember. So three reasons: automatic stabilizer, monetary policy, and shock observer. What do you mean by shock observer? So if your economy is in shock, it will get absorbed by exchange rate instead of crashing the economy. Your currency will depreciate. You have to bring more currency to buy same dollar, right? Rather than your economy is in shambles, there is no jobs and there is no people getting any enough salary. That will not happen. Okay. Prices will go higher if you are import dependent. Why? Because you have to buy more, you have to gather more currency to get that $1, and hence anything in dollar terms will be costlier now for you. For example, earlier your mobile was 1 lakh rupees, now it will be 1.5 lakh rupees because of the depreciation. Clear? Because of the depreciation, that's what will happen. Yes, be ready. Okay. So shock observer, you got it, right? Monetary policy, you got it. Automatic stabilizer, you got it. Now, downside of this system is, like in fixed exchange rate, you have a downside. Here also you have a downside. What is the downside? Exchange rate uncertainty, which makes the business planning harder. A company that signs a contract today, delivers a goods in 6 month time, has no idea what will be the exchange rate. Which was the advantage of fixed rate, right? That I have booked up iPhone 18, which will come on 9th of September. I know the price and I know how much I have to pay in terms of rupees. But same thing is not applicable for floating rate people, where you don't know what will be the price of that iPhone in your currency on 9th of September. Why? Because you have floating rate. Now always remember and write it down. For floating rate, hedging exists. To manage the floating rate, you need to do hedging. Clear, everyone? Hedging. Floating rate, hedging. And that's what forward contracts solve. That's what exactly forward contract solve. Now, floating exchange rate you have understood. So let go ahead and you look into a system called, let me now connect it one thing, and that is two things you have seen earlier modules as well: interest rate versus exchange rate. Both are connected, and let me draw a link between these two. How they are linked together. Under a fixed rate regime, always remember, central bank has one and only one job. What is that? To maintain the peg of 3.75, like Saudi Arabia is doing. So every interest rate decision must serve that goal. If you are increasing or decreasing interest rate for your population to take loan, the ultimate aim is to maintain that peg. If the peg is under pressure, central bank must raise the interest rate to attract foreign capital. Write it down. Then only you will remember. Otherwise, you will forget tomorrow. If peg is under pressure, what central bank will do? They must raise the interest rate to attract foreign capital in the country, and that will reduce the headache or stress on peg. If a domestic economy is in recession, what will you do? You will lower the rates. You have to lower the rate, right? But that's the trap. You can't do it in fixed rate regime, because if you will lower the rate, nobody from outside will come and invest in your country, which means that your monetary sovereignty has been surrendered. This is another concept of economics. As you are learned people in economics, so I'm not going to discuss that. Now, under a floating rate regime, central bank is free. Under a floating rate regime, central bank is free. Why? Because they are not doing this peg management. What they are doing is real work, which is looking into interest, how that will create more jobs, how that giving lesser interest loan, what will happen? Company will start new expansion plan. They will borrow cheaper, invest that, create more jobs, and eventually earn more. So floating rate advantage is exactly this. Now, if you have understood that pass, always remember in M&A cross border. Yes, M&A cross-border regime analysis also. Step one is any cross-border M&A currency risk framework, you have to have hedging done. Achha, tell me where hedging will be required in this case. If I am acquiring a company in European Union, okay, which if I am into fixed rate scenario or fixed exchange rate condition, or I am into floating exchange rate condition, under which system I will have more problems, or where I have to create hedge, under which system I have to take a hedge as well. If I am doing a merger acquisition I'm acquiring a company in Europe, what it means? I need to pay in European Union. What it means, if I am in fixed regime, I know exactly how much to be paid after 6 months down the line. If I am in floating, what will be my problem? I don't know what will be rate of euro that day. So what will I do? Where hedge will be used, in floating rate regime or fixed rate regime? Somnath says absolutely floating rate regime. That's what exactly people does. Yes, that's exactly people does in merger and acquisition. They take a hedge. Now, there is another concept called reserve currency board. Reserve currency board. Currency board takes a fixed exchange rate concept to the extreme. So reserve currency board does nothing but take the fixed exchange rate and take it to extreme end. think that it becomes a legally binding to maintain a fixed rate. Yes, here is how it works. For every unit of local currency in circulation, every unit, if you are circulating only, say, two people are there and each of them has 1 rupee, that 2 rupees central bank is required by law to maintain against that dollar, right? So dollar versus those 2 rupees in circulation will be fixed. Yes, and they will be keeping that reserve all the time. So if that 2 rupees becomes 4 rupees, eventually you have to increase that number. So if there are, say, $100 billion in circulation, Hong Kong Hong Kong dollars is $100 billion in circulation. The Hong Kong Central Bank, which is also known as HKMA, Hong Kong, main bank, they are they must hold approximately 100 billion HKD worth of US dollar in their reserve. Like today, gold pegging is done, right? You remember before fiat currency was introduced, your economic teacher must have talked about, before the foreign currency became, before the fiat currency came into circulation, there was a gold pegging happening, right? Before 1970. Similarly, if you are following a reserve currency board, you will also keep that much currency in your account. Dubai specifically work with this reserve currency board scenarios. They do not do it only with dollar, they do it with 5 currencies, not one currency. Okay, so Dubai, anyone want to take that case study? Okay, let's not do it because there are not enough people. No problem. People who have done the homework, they will be only doing this presentation. Yes, this one we will do it on Monday morning. Okay, Monday morning we will do it. Yes, on 31st. Clear? So what does this mean in practice? Exchange rate are absolutely fixed in this case, Reserve Currency Board. Not a policy fixed, actually legally fixed. Central bank cannot print money unless it first acquire more foreign currency. Then only they can say, I have a reserve currency scenario. The money supply is 100% driven by balance of payment. If balance of payment disturbs, BOP, yes, CAD and BOP, which you must have learned again. If that changes, you have to maintain that credibility. Now, what is the benefit here? You become more credible because you have, foreign asset already in your bank. Second, low inflation, you can control your inflation. So your people will be much happier. Drawbacks are zero monetary independence. Why? Because now you don't have enough flexibility to manage your interest rate. Second, no lender last resort. If a banker have a liquidity crisis, central bank cannot print money to bail them out. Simple. All banking institution will be exposed. The best example is Hong Kong versus USD since 1983, Bulgaria, BGN versus Euro 1997, historical Argentina before they become bankrupt. Argentina has gone for bankruptcy not once, not twice. Okay, so they went before 2001 crisis. They were also reserve currency board. They had a reserve currency board. Clear? Clear, everyone? Now, if that is clear, remember the Reserve Currency Board is, of course, is one of those very difficult talk where market hours are 24 hours, 5 day a week. You have to maintain liquidity, etc. All that has to be done. So let's go ahead and learn about market participant of foreign exchange itself. Who all are participants? Who all are participants? And there are 7. Remember those 7 and you are done. First, start with foreign exchange. Always have a hierarchy of participant, and let me walk through each of them. The first one is retail. Retail clients or individuals. Who are retail clients or individuals? You and me at the airport on exchange counter. Yes, we are going to United States, we are going to London. If we are standing in front of those counter and asking for dollar or pound, we are the retail client. We are price taker. We always take the price, whatever is sale price set by that exchange counter, we are always taker of that. We take whatever rate is offered. And that's why Never do exchange on airports. Never do it. You will always lose. Why? Because you are a price taker. They will always buy low, sell you high. So you are the one who is taking that sale. And hence, never do that transaction. Going forward, remember, whenever you are traveling with your family, spouse, mother, father, remember to tell them, take the currency before you start your journey. You'll always get extra 5,000, 10,000 rupees. Okay. You will always have that extra. Second, participant is authorized dealer and money changers. These are the guy who are opposite of your counter. These are licensed entities that serve you on airports. Have you seen those? Yes, they buy foreign currency at the interbank rate and they sell at the markup rate. They increase the price and then they sell. The spread is their profit. Third participant is central bank. Monetary authorities, the giants, all these big guys are third participants. They don't trade for profit, they trade to manage their country currency. Central bank and monetary authority, what they do? They manage their country's currency and foreign exchange reserve. RBI, US Federal Reserve, European Central Bank, ECB, Bank of Japan, BOJ can move markets just by announcing an intention to intervene. If they say that I'm now going to buy because my currency is losing its value, I'm going to buy it. You reduce the currency from the market automatically, supply will reduce, demand will be remaining same, you will have better prices. Multinational corporations are fourth body. They are also known as hedgers. Companies like Apple, Samsung, Reliance, TCS, they need to hedge. Why? Because their contracts are 10-year, 20-year. So they have to hedge those all future contracts as well, right? That they should not lose money because your currency appreciated. So they have genuine foreign exchange need, paying supplier in foreign currency, repatriating profits, hedging imports, export contracts, etc. These are the biggest hedgers. All companies or multinational corporations are biggest hedgers. Then comes commercial bank, your next door guy. They serve as a corporate and retail clients together. They also trade among themselves at an interbank rate, like in money market, to manage their foreign exchange positions. After that comes the brokerage houses or ECN platform, electronic platforms or electronic matching engines that brings buyer and seller together. Others, that guy who did the presentation, he was working in that area, right? Who wanted to compete with JP Morgan.
Uh,
Yes, they
yes.
are the ones who are creating this platform, enabling both party to trade. Reuters matching, etc. happens here. Last one is nothing but investment banks. Investment banks and hedge funds. Both of them, like Bridgewater, they are the most sophisticated players. They are looking for that arbitrage. What they are doing? So remember, hedge fund does what? They look for arbitrage. So on a cross-border merger acquisition deal, your client is a typically multinational corporation, and your job is to help that company for their foreign exchange exposure through a proper process. Hedging transaction, translation risk, and economic risk is your duty to manage. Right? Now, forward rates and covered interest parity is another concept which you have to understand. What I will do, I will stop here. Yes. And again, I will tell you guys to read that pre-read material. How many of you did it by today? And how many of you want to do it by day after tomorrow? Yes, 2 more days. How many of you will do it? Put me in the chat box if you want to do it in future, right? And put done in the chat box if you have already read the pre-read material, complete end to end. Done if you have completed end to end. Okay, so many of you want to do it going forward. Good. Others done. Sasangmi, Ankit, Vaishnavi, Mohit. So either done or me. You cannot be in between, right? Either done or me. Okay, so everybody will read. So you have 2 days more to read and come back, and then we will solve this problem in the class. Okay, forward rate and cover interest parity. See, SIRP. Both are very important. Little technical, but don't worry. These are the only few things which are technical. We'll finish by tomorrow, a day after tomorrow, or whatever day we will meet. Yeah, when your internship is finished. Yeah. So 50% of you, of course, I'm seeing you on Monday. Bye bye. Take care. See you. See you guys. Bye.
Bye, sir.
Bye.
Thank you so
Thank you, sir.
Thank you, sir.